Genia Turanova, thanks so much for coming on Wall Street Unplugged again.
Oh, thank you very much. I'm so happy to be talking to you. Today is a fun day in the market.
I know, right? We're seeing the market really come down, which is, we'll get to your Moneyflow Trader portfolio, which is, used as a hedge. But of course, the market's been surging right now. But now we're going to see a lot of demand for it, obviously. But I want to talk first because you have an economics background and what's going on with the stock market, because we're seeing things and it's hard to explain to people, right, for the first time that I don't know if I could teach a young investor anything when they're buying stocks with no earnings or SPACs that are, coming out at taking over companies at $20 billion valuations with no products on the market yet. It's tough to tell them to take it easy when a lot of these things are going up 3, 4, 5x. But as we're seeing right now in the market, we're seeing a major correction. What's your view of the markets and even the economy? And is it a sector rotation thing? Or are you nervous right now for the whole market to come down? But let me hear your thoughts, because I love when you talk about, the macro point of view. And I know that leads to a lot of ideas for everybody.
From the macro point of view, the market doesn't look too scary only because of the interest rates that are artificially low and because of the enormous amount of money that's been released into the economy. There's two sides to the this money equation. There's a lot of extra money that was printed, quote unquote. The Fed's balance sheet has been, it's almost doubled over the past year. And the last time it did double in a short period of time was during the Great Recession. So it is a big deal for the market, for the market support. And it's also a very different from anything we really have experience with because of the low interest rate. Money is free. Rate is low, money is free, do whatever you want. It's not going to, last forever, but low rates does support the economy, does support the market. And it gives you the feeling that you'll be fine for a long time, which is not likely the case. At some point, it will balance out a little bit, like it did in the past 3 months, too. I think it was a little bit of a rotation with energy surging, 30% or more, and the utilities declining 5%, I think, over the past 3 months. Mm-hmm. And the market was up 9% with energy, as I said, up 33, 34%, and the financials up 20%. So it's not like you buy just anything and it will go up. Even over the past 3 months, you buy something safe and it would be down. That speaks volumes to what you just said about the young investor. Just throw the money at the market and it will do well for you. I really don't think it's the case long term.
Yeah, so let's talk about that, because I guess the big question, right, everyone wants to know when will it happen, because we could really say with the last 20% move higher before the recent decline this week that, the same factors were in place, low interest rates, free money, and, eventually when does valuation matter? And that's a tough question. I don't know how to answer it, but when does valuation matter? Because it could be the same argument. I'm always worried about when people are buying the market for the same exact reason they bought it 20% ago, or buying a stock for the same reason, because it seems like a lot of that is factored in. But, we're seeing long-term rates go higher. Is that something? I mean, we could always have yield curve control coming from the Fed, which they did in the past. But, what could be the catalyst that really pushes us down? And maybe that's what we're seeing right now. Although, we're down a little bit compared to how much we've come up. But I guess everybody wants to know, including me, and it's hard to determine it, is, when's that time frame? When are valuations really going to matter again?
I can tell you that I cannot give you the sure answer. The only sure answer is that this time is not different. It may be slightly different. The environment has changed. So the normalized valuation may be a little bit higher than we used to. So in the sense, it's different, but it's not different in the sense that whether the market valuation matters. Because if equities represent ownership, you don't want to buy anything that's priced 100, 200, 300 annual future income. Do you want to own any asset that will potentially return something to you in a normal way in 300 years? Probably not. So eventually, this will all balance out a little bit. Maybe with free money, your timeline for how much you're giving to give your equity to pay you back, your timeline will expand. Mm-hmm. But again, the question is by how much?
Yeah, and to be fair, I mean, it just is a tough question because I'm trying to figure it out too. Where you think you're smart taking profits, and you'll see a stock double from here when it was really expensive, but now we're seeing. Right. Talk about where it's not all stocks, right? So we've seen the ESG stocks, environment, batteries related stocks in the major growth trends, especially in the SPAC area. These things have taken off tremendously, but we are seeing a rotation. We're actually seeing even in the market today where the financials are coming back. The cyclicals have done well this week, right? These are plays on the economy where, you just see the NASDAQ get crushed in a lot of growth stocks, and those are the fan favorites. Tesla down more than 20%. And that's a lot of people talking, but there
in 2 days.
Yeah, I know, right? And there are things that are working here. So, talk about the rotation here and maybe cyclicals, but it's not so much where I think so many people, right, they look at the market as a whole and say, oh, I got to get out. But a lot of individual names are actually performing pretty well over the past 5 days if you're in the right areas, right?
Absolutely. What I think is happening, and it might be just the beginning of the process, is the buy the rumor, sell the news kind of environment. So we have been buying the rumor for the past 9 months. The reopening, it's not really a rumor, it's happening. We don't know the exact timeline is not clear, but we know we're reopening. We know the economy is coming back. We know that it's coming back strong. We know for sure that we're going to beat it. So that's not a rumor per se, but it's a rumor in the sense that you want to be ahead of the market, ahead of the trend, and everything that was a reopened trade has been bought. Now we're seeing selling the news kind of environment when we do understand that the vaccine is working. We do understand that it's may not be as fast as we would like it to be, but in 2021, we will probably be significantly over this by the end of the year. Mm-hmm. So again, another 10 months, give or take. So again, it's selling the news kind of environment. You don't want to guess when the buy the rumor, sell the news will change. So you want to have a little bit of both. But I think that's what's happening.
Yeah, no, it definitely makes sense to me. And I want to turn everyone's attention over to Moneyflow Trader, because this is one of my favorite newsletters at all, Curzio Research. And when you took this over, I mean, the timing was really, really good because we saw the market absolutely crash. And this is just a portion of this, but most of it is you're buying puts for protection. And of course, you're buying puts, right? You're betting a stock. You're not going short, so you can only lose the amount of money you put up. But with a crazy market like this and how nuts it is, like when you saw the market really come down tremendously, March, April, starting in February, you saw positions go up 100, 200, even 500%. But now it's a bull market in every single thing in the world before this week, right? So, of course, that portfolio is going to take, but explain to people, and I try to do it, but I want to hear it from you as well, is what this portfolio is meant to do. Because when I look at it from a hedge point of view, it's so important in this market. I understand that, especially now this week, people are like, wow. But explain that part of the newsletter of, using it as a hedge, which is something I do for my own portfolio.
Right. So I do believe in the market. I do believe in the market wisdom. And I do believe that over time, the markets do move higher. And that's really the basic of making money in the market, not being persuaded that, now it's going to be a 10-year bear market. You get out, sit in cash, and you'll be fine. I think you should be invested. And to be invested in a difficult environment like this, when everything can turn on a dime, it depends on the Fed support. Fed has been pledging the support, but again, it's already in the news. It's already priced in. In a crazy environment like this, when any kind of recovery is already priced in, anything can happen. Not to mention, given something like last year, which almost exactly a year ago, we had a market high. And then we experienced the fastest bear market on record. You can't prepare during the bear market, especially as fast as the furious has been coming on lately. You can't prepare during that decline. Volatility goes up, everything is super expensive, and you can't really buy a hedge unless you did it ahead of time or benefit from the hedge. You can buy it, but you're not likely to make money on it because you're buying it at a very high price. As we did with a couple of hedges that we didn't do so well because we're trying to hedge extra during that decline. And again, just an example of you need to be prepared. And it's just everywhere else, you must be diversified. So you spread your bets across few positions. Some have high chances of success in the recovery. Some have much better chances of success if we're stuck in the mire of not growing economy. So you have to have a few hedges across the universe of potential reason for the market decline. And of course, you want to own a hedge on super crazy valued stocks. Not every single one of them, and not every single of your hedges must be on the super valued stocks, because again, as we just discussed, the high volatility and high valuations may continue for a long time. But again, the more you hedged, the better you can be invested elsewhere. So if you hedged, you're actually benefiting from this market upside without, well, maybe not without the worry in the world, but with better confidence.
Yeah, and I came to you a few months ago, maybe like 5 months ago, and for me, for Curzio Research Advisory members, I wanted to provide one of these hedges. So what I did is we bought a put on Disney. Dead wrong, the stock went up tremendously. And what I instructed everybody to do, just to bring in a real example here, and I even consulted you on the trade as well before I actually did it, because you're the expert in this field, I said, look, this is a trade where you put 2%, 3% of your portfolio in, and this is the most leveraged company to COVID, right? So if everything starts reopening, this stock is going to take off. And if not, this stock's going to get nailed. So what happens is the recoveries happened, the stock took off, and that's okay. We lost a full amount of that position, right? But the rest of our portfolio is surging because we're well positioned for everything else. Now, if the market came down, that small 3% position on that option could be worth 10, 15% of your portfolio if it comes down. And that's how you hedge with a small amount of money. And I know that process is difficult for people, and people want, full upside. And even for Moneyflow Trader, right, Genia, that's not the only thing you provide Moneyflow Trader, where you have long positions now too, and structuring the portfolio the right way, which is a great job. But that's the most important point to me, right, is just taking a small amount of money, being able to hedge. And if you're right, it's going to amount to a massive gain. And if you're wrong, you should make sure everything else in your portfolio is going to benefit. This way, that I'm willing to lose 2-3% of my portfolio because everything else is up 15% plus. And even more than that during this bull market. I mean, that's the way I kind of look at it in a real life example.
Absolutely. And that's a good point. Ideally, you don't want all your trades point in the same direction. That's when you can lose a lot.
Mm-hmm. Yeah. No, absolutely. And, for this portfolio, I think right now it's funny because I can see the market's been up and, you could see that reflected in the performance, which is fun. Now the market's down, and everyone's like, okay, what do we need to do? Because when you see some of these names fall 20%, like in a couple of days, these things could go up, 5x, 10x right away. And that's a great hedge. It makes you feel good because now you're not worried about looking at every stock every day and you're getting crushed, where if the market comes down, you're protected. And Genia, you've been doing this for a very long time. You know a lot of big events. This is how the best investors, even the hedge funds, this is what they do, right, with their portfolios. And it's, it helps you last in the market and, not get crushed during times when things are bad. And also, when times are good, it's perfectly fine. But getting crushed, you lose everything. You can really get hurt. But this is like a strategy used by I know you is some of the best market professionals out there.
Generally speaking, that's what hedging is. you're willing to lose 100% on your hedge if everything else does well. And that's what we're trying to do. And yes, absolutely, that's what the professionals do. And this is what when I was in business school 20 years ago, I strived to understand. I was like, and then down on me, you stay invested. That's what that's what hedging does.
No, that's great. That's great. And just showing a picture of here, Moneyflow Trader from a Curzio Research site. If you want to learn more, you can go there. But let's change tunes because now Moneyflow Trader is coming into focus with the market coming down. But I'm also going to show this because you are also editor of Unlimited Income, which is a front-end newsletter. So it's a low-price newsletter here. Unlimited Income. Tell us a little bit about that product. It's something that I really love because you take a different strategy towards income that, I'm very in favor of, where sometimes people will just look at the yield and look at MLP or REIT and it's paying 6%, 7%, 8%, and they don't realize that can't be sustained, especially if the underlying security, the underlying company is not a good company or maybe not growing. That stock could fall 20%, making that 8% yield absolutely meaningless. You take a really cool approach to this, and even the last, I think it's 8 or 9 picks that you've made in this portfolio are all in the green, doing very, very well. And again, this seems like this is an area that's going to see more inflows into it, especially in certain companies. But talk about your methodology behind this. This way we could, bring everybody in here.
Again, we did talk about it, and I love that we've shared the same approach. That if you want income, you must have growth. What I mean by this is that you can pick the best of this market. Stocks that can grow profits, and by extension, they grow dividends over time. And this way, you don't lose your principal. Well, maybe again, that's why you diversified. You can't promise that you cannot lose your principal on any of the stocks. But again, you stay diversified among the best of the dividend growth stocks. And this way, you can almost guarantee that your income will go up over time. Your principal will be at the very minimum safe, or in our situation that we did over the past 6 or 7 months, your principal will go up, giving you again some cushion in case something goes wrong with the market. If you select good stocks, the income will be there, and the principal will maybe give in a little bit, giving you again more opportunities to buy because of your stock selection. Is all pointing to safer stocks that can grow dividends because they do have sustainable business with underlying growth. That's the only way you can beat inflation, which we all know is coming, and generate some safe income in this market.
So, a good example now, because we're seeing yields start to rise, right? We had a bunch of, hundreds of billions, I believe, in negative yielding bonds, right? And so, but interest rates are rising on a long term right now. So how do you position yourself? Because you see that, which, again, higher interest rates usually results in taking risk off the table, which what we're seeing right now. I don't know if that's the cause of the market pulling back while interest rates go higher. But do you look at it as if interest rates going high, you expect inflation. I mean, that seems like a great trade for bank stocks, which pay very high yields and are still considered cheap. And JP Morgan, I think it's at a new high, but a lot of these names aren't. I mean, is that a way you will look at it as well in a higher interest rate environment? You find it easier, or is it just, reallocating or finding new ideas? But does that change your philosophy at all with interest rates rising?
It does change it a little bit, but not that as much as the change the entire strategy. It would help me to pick my next stock and then the stock after next, because the market is changing. You must change. And again, you go back at your portfolio, if you review it and see which of your plays will work out long term, regardless of interest rates, and which are really susceptible to higher rates. I don't think too many of my positions are susceptible to higher rates, but of course they're not immune. We have utilities that gave in a little bit together with the entire utility sector. We had a few REITs that didn't do as well as the rest of the market, but the rest of our portfolio surged, had the financial technology, actually a few technology stocks. I have an industrial stock that has done well, and I expect it to do even better in the coming year. So overall, it's all about the balance, and it's all about being nimble and knowing where you are and anticipating some changes, and maybe playing back a little bit of your ideas and even sell a few that are not going to work out. But altogether, if a company is stable, if its profits are growing, if it's in command of its own destiny, whether you call it franchise or just a strong growing company, that's what you want to own.
No, that makes a lot of sense. And I guess let's get to the fun part, right? Which is, people always love ideas. Is there any ideas you could share, maybe even, hedging wise or for limited income? Because again, everybody always loves ideas. And of course, you're not going to give away anything that people are paying for, but you also have, lots of ideas to always share, which, we talk about. And just on a side note, Jenny, I'm going to share the secret is, we go back and forth and you ask for research reports on different companies. And every time you do that, when you ask for research reports, I'll send them to you. And there's if it's 15 different companies you give me, there's probably 7 or 8 that I'm totally interested in. And then some of them I never heard of. And I was like, wait a minute. And it hits my radar because it's funny the areas that you look at by asking me that and say, hey, do you see research reports on this from sell side analysts? But I love that part because it allows me to see, what you're thinking, but it gives me ideas as well. But let's get to the idea part. This way we could share that with everybody. If you have anything out there you want to share.
Well, sharing is a great thing, as you just said. So I think that one of my long-term favorites is something that will continue paying your account in nominal terms and in the potential price appreciation for a long, long time. It's a utility. So again, don't think that it's not going to do well in the rising interest rate market, because it's a utility that's leveraged to one of the main growth trends over this coming year and probably decade. It's a clean energy utility. It does both. It provides you, Frank, and the rest of your state with the electricity in its regulated part. And it also owns a lot of clean assets all over the country. Yields 2%, nothing's wrong with that, and can potentially go much higher than it is right now. NextEra Energy is my first pick. That's the name of the utility, and it's actually, in fact, it is the largest utility in the country. So there's nothing too exotic about it. Probably when you saw me asking you for a report, you knew what I was going for this particular stock.
It's funny. So next, you did a great job of masking that to the last second, right? But NextEra Energy, you got everybody excited for utility, but NEE is a symbol. And it's $160 billion market cap, right? I didn't even know it was that big until you said it's one of the largest ones, or is the largest one. And yeah, I didn't even know they were that big. That's a monster company. But yeah, that's awesome. Thank you for sharing. And what about hedging wise? I mean, you have anything there that people could say, hey, you know what, we'll buy, and it doesn't have to mean that you have to buy puts or anything, but maybe it's something that, you're looking to buy that might perform while the market doesn't do so well.
I think one of my better ideas, I guess that's a better way of saying it, is silver. I think silver is a little bit of everything. It's a precious metal. This is why it will probably continue benefiting from the money printing. It's an industrial metal. This is why it will continue benefiting from the recovery trade, from reflation trade. And it is also a clean energy metal, useful in solar. So it's three-way play. It's not as exciting probably as the Bitcoin or other cyber currencies, but it should do well as a hedge, and it should do well as a recovery play. Silver is a little bit weird because of its in the middle kind of status. It's a precious metal, and it's also an industrial metal. But all said, it outperformed the market by a wide margin last year. I think year over year, it's up about 50% or so. I'll take that.
No, that's definitely cool. And I know you've been early to silver, and you're saying, well, not that exciting, but I think the Reddit crowd might think differently, right? Because all this silver that they bought and everything. I used to think silver wasn't exciting either, but apparently it is to the young investors. And these people, some of them are holding long term. It's just that was funny you said that, because usually it is kind of gold and silver and boring and hold. But, to see young investors saying, hey, silver, and again, it is linked to two different things that are really cool right now, right? So, and just the trends in the industrial metal part, but also just like, usually a safe haven and stuff. But, all right, Genia. So listen, we covered a lot today. We covered economics of both of your newsletters. I just want to say that thank you so much. And I love having you, work for us. We get great emails from you all the time. You're someone who has a ton of credibility, and I've seen it just where, I've been in this industry for 25 years, and you see a lot of people where they have losers and they don't mention them. You'll talk more about your losers and your winners and say exactly what you're going to do. And I think from a subscriber's point of view, they all know sometimes we're going to get things wrong, and that's what they want. They want to know someone's, has their back and they're in their corner. And just the emails that we're getting and testimonials, can attest to that. So I just want to say thank you so much for coming on and giving your analysis. And Moneyflow Trader and Unlimited Income Guys, you can go on our website if you want any more information. But thanks so much, Genia, for coming on. I really appreciate it.
Anytime. Thank you.